AI and investment, and yeah, exploring the link between HFT and market fluctuations.
So our research question was, we were wondering how would widespread algorithmic trading impact market volatility, and what strategies would serve best in this type of environment to mitigate these risks? And the order for presentation, first we're going to go over what algorithmic trading is, what AI is doing now, and then we'll go over some case studies. Then we'll explain the domino effect, our solutions and conclusions, and we'll answer any questions.
So yeah, starting with the concept overview.
So here are a few key terms that we'll identify. First, a futures contract is a legal agreement to buy or sell a specific asset at a predetermined price and at a predetermined time in the future. The instance duration it takes for an order to be executed is like the duration between when you press the button to buy the stock and the stock is actually bought. And market liquidity is how easily an asset can be traded without impacting its price. And usually a market with more people or more buyers and sellers is more liquid because there are always other people to buy what you're selling or people to sell what you want to buy. And here's how algorithmic trading basically works. So the algorithm, which is the market maker who buys and sells stock to people in the market, they read in market fluctuations, and based on what they read, they sell their stock. They decide to buy or sell, and that's how they profit. But the problem is that all this is happening in a black box, so all the crazy computation stuff, you don't really know what's happening, and you're entrusting your money to this robot.
Clearly, it's a problem when you don't know where your money's going.
And now with AI, these algorithmic traders are even more advanced. They can look at historical data, identify trends based on how trends behaved in the past. They can update based on real-time data and make decisions in milliseconds. They can read the media news and decide if, well, are people happy, are people disappointed, negative? And they can also observe market microstructure, which is like how liquid the market is and where the dark pools are and what the market looks like and things that we can't really notice as humans. And as you can see, the adoption of AI is only increasing because AI is so advantageous to trading, especially when speed is so important. If AI can analyze all these factors at once, imagine what advantage you would have as a trader. You can earn so much more money through time and the quality of your investment.
Yeah, especially if you think about how stock markets work and you break it down. It's essentially a set of decisions, right? Where you put your money, when you put it, and how much of it you put there, right? And a lot of the advantages that people get in this sort of system is that they're able to know faster, analyze the economy at a faster rate, and be the first people to make those sorts of decisions and capitalize on changes in a very liquid, fast-moving market. So if people are clearly moving towards AI, and that's becoming a lot more accessible, right? And we see a lot more people investing in it. What essentially happens to who has an advantage in that sort of system, and what is the result of such widespread thinking when people all make the same decisions?
And now we'll look at how algorithmic trading is used in high-frequency trading. So the difference between how a human would trade and a robot doing high-frequency trading would trade is that a human trader might read the news, spend a lot of time investigating, well, which stock should I invest in? And after they do all this consideration, they might choose a stock that they see has potential to grow in the long term. And over time, they earn a lot of money. They earn a stack of coins from one stock. But high-frequency trading is different in that it analyzes the market every single second, and based on how prices are currently changing, it might sell stock at 1 second and buy stock at the other. So because it can manage so many stocks at once and read so much information at one time, it earns like a few cents every second, but since it's holding so many stocks and all of these stocks are earning a few cents, all of these profits add up, and that's how high-frequency traders make money. And as you can see, because high-frequency trade, well, the market is always fluctuating, right? So you can always make money off of HFT. So this is why the high-frequency market is projected to grow over the next 10 years. So you may ask, what happens if all of these algorithm traders make the same high-frequency trading decisions at the same time? they all buy so much stock or sell so much stock at the same time because they look at the same information.
Or essentially when all actors in a singular market all do the same thing together. To do that, let's take a look at some of our case studies.
So a few terms that we'll identify before we go on to our case studies. A flash crash is a sudden rapid decline in the price of an asset followed by a quick recovery. So it can look like down up or up down in just a matter of a few minutes.
And the Dow Jones Industrial Average is an important number we'll be analyzing. And essentially it's this average across the stock market that tracks 30 large publicly traded companies on the NYSE and NASDAQ. So our first case study today is a very prominent flash crash in 2024 with Lyft. What happened was that essentially in the off hours of the market, so how the stock exchange works is there are these daytime hours where most of the trade happens, but then there are off hours, and most investors take this time to pull away, let the market make adjustments, and come back. But what we saw was that in the off hours, 45 million Lyft shares were traded, when the usual average during the daytime is 15 million. So what caused this extremely massive spike in the span of only like 30 minutes? And what happened was that there was an important typo made on the side of Lyft, where a number that kind of analyzed the growth of the company itself added an extra zero on the end. And while most of the human traders were off at the market, all of the AI that was there capitalized on that instantaneously and altogether caused a massive spike. And as we can see, there's a 67 spike in share prices that went down almost immediately in the end.
And now we'll look at the 2010 flash crash. So what happened here is that the Dow, it dropped 9.2% in a matter of a few minutes, and after 20 minutes, it recovered. So you might be wondering, how did this happen? Like, no human could have caused this, right? And you're right, it was the fault of algorithms, and there was a total of a $1 trillion loss, and there was some sort of recovery, but it was still a tip. And here's a timeline of what happened. So at 2 p.m., the Dow started dipping down. And it was a pretty volatile trading day. In the UK, they were having their election, the Greeks were having a debt crisis, so a lot of things were happening. But at 2:32, the market decline gradually steepens. And from 2:42 to 2:47, it drops to its lowest point of 9,000 points. And at 3, it recovers back to almost to normal. So let's look at what happened at 2:32. So at 2:32, Waddell & Reed, this fundamental trader, used a sell algorithm to sell $4.1 billion worth of 75,000 S&P 500 E-minis contracts. So E-mini contracts are these future contracts that people often look at to observe even how the equities market or the stock market is doing. And Waddell & Reed will use an algorithm and just dump all of these into the E-mini market. And you might think, well, algorithms are pretty smart, right? I just said earlier that they can look at the news, they can do statistical models. So what went wrong here? But here, this sell algorithm was not very smart, and it did not consider the price or time, and it only targeted trading volume. So this algorithm, it didn't care what price it was trading at. It just said, I just want to get rid of these future contracts as quick as possible. So I don't care if I sell these at like 1 cent, I just want to get rid of them. And that was a problem because, well, after the sell algorithm dumped all these contracts into the market, the high frequency trading algorithms in the market seized the opportunity. They're like, oh, wow, these futures contracts are so cheap, I'll just buy them and I'll sell them later. But the thing was, no one wanted to buy these future contracts because they were so cheap and the price of the market was dipping down. So they just started selling them to each other, right? Because dumb algorithms make friends with dumb algorithms, and then they started playing hot potato. So what this made it look like was that the supply of these future contracts was really high. Everybody wanted to get rid of their future contract. But when supply goes up, the price goes down, and that's why we saw a big dip. So a lot of HFT traders started to leave the market. They're like, I'm not making any money out of this. And soon there was a loss of liquidity because, well, HFTs provide liquidity because there's so many of them and there's always someone there to buy or sell your stock. But since they started leaving, there was a loss of liquidity and therefore an increase in market volatility. And now we'll be going over the domino effect, which is why this happens, why everyone does the same thing at the same time.
Essentially, why this issue is so important on such a large scale, and a scale that's only going to increase going forward.
So what happened in the 2010 case was that all of these algorithms were selling at the same time because no one wanted such a not profitable futures contract, so they all wanted to sell. And because they all wanted to sell, the supply increased and the prices started going down. And when prices start going down, well, something called herding happens. Everyone else starts selling as well because when the price goes down, you don't want to buy something that's going to lose money. And in the Lyft case, it was the opposite. The demand for the Lyft stock went up because there was an extra zero. So it's like, oh, Lyft is going to be profitable, I should buy the stock. So everybody wanted to buy the stock, and when demand increases, price also increases.
And so now we're going to basically take you through our solutions and conclusions to this entire dilemma. And we're going to be doing that on two scales. First, on the large scale, so that's kind of global markets, larger marketplaces as a whole, and then we'll go through individual. So as individual investors, what is the best strategy to both profit off of the AI, but also not suffer from fast crashes? The first is essentially operating off of crash-resilient market models. And what this does is that it changes how the stock exchange works entirely. And what this means is that stock exchanges, regulators will place certain requirements and limitations on trading. So what this does is that there are requirements for numbers of shares traded and the speed at which you can do it, so that no individual person, or on the demand side, right, or no individual seller can really facilitate trade at such a high speed. And then so if you were an HFT, right, and you were placing these millions of orders in seconds, how that works is now there are limitations on these traders, so they would have to space them out over the course of hours or days so that such immediate drastic crashes can't happen all at once. The second kind of way to do this is to make essentially a competitive AI market. How that works is essentially, as a whole, the market and the world kind of pushes for innovation in AI. Is that what investors want then is better AI, better models that can think faster, think better, avoid disasters like flash crashes, come with better opportunities. And when this kind of scaling happens, right, this effect where now there are more valuable AI models and now there's a market of scarcity, right, what happens then is that there's a natural kind of organization of, like today, right, people who have more resources or have better investment strategies do better. Well, this can kind of happen on a similar scale where there's different kinds of AI models all thinking differently and people invest kind of on that level and all invest in kind of different AIs, then you can kind of see a different effect happening in the economy and you avoid everyone making the same decision. So now let's kind of think on the individual level. So we have three different essential solutions that can be provided. First is a circuit breaker or dynamic algorithm, and that essentially is something that you implement into your AI model that causes it to work the way it does, and you are able to profit off of its assets, right? Its ability to think really well, very quickly, and analyze so much more than the individual can. But you place certain limitations. For example, the AI will shut down or send you an alert and have you intervene when there are certain irregularities that they notice in the market, or if they spend a certain amount of money in a certain place for a certain amount of time. So example, they can't have full access to all of your accounts and place all of it on the singular order at once. They would have to have you come in and do that. Or if there's an irregularity in the market, for example, they're seeing some sort of flash crash happening, it'll stop and refrain from engaging and following this kind of herding effect so that you can come in and make the decision for yourself. The second is kind of you diversify your AI. So similar to how you diversify your portfolio or diversify where you put your money, you can invest in different AI models. For example, this kind of capitalizes off the fact that there would be multiple options, but you are able to have different thinkers working for you that think differently and place your money in different places at different times, so that if one were to kind of go with this herding effect flow and then, enter a flash crash, lose all your money, etc., you won't see as dramatic of an impact because there will be a lot other places for your money to go that prevents such an event. But in the end, there's really no getting around how to do it yourself. You know, you have to know where your money's going and when, and know how to invest for yourself, because no matter what happens in an economy where, you know, the assets like time is kind of spread out so everyone is able to work really quickly, right? You're not like the fastest anymore. If you're able to think on a deeper level and invest on your own, you know, with superior strategy, you can do a lot with working with your AI and working with your stocks to profit off of it. So yeah, learn how to invest. Any questions? Over there, is that a question? Yeah.
So when you say you should diversify your AI models, how would you go about choosing the right model to actually invest?
I would generally work off of the sorts of circuit breakers that are in place. I would want to understand how this AI is limited and still able to operate, because I think it's sort of inevitable that at any time, you know, these newer like technologies are going to fail, but I would want to make sure that I have the technology that best allows me to intervene. So I would kind of look for technologies that are more adaptable, have better statistics and access to data, and then be able to stop itself at superior points that allow. So not one that's going to stop every time there's any sort of spike, and not one that's just going to let everything happen, but one that has the greatest amount of training and data access so that it's able to pinpoint when there are really irregular shifts and then call me into action. Yeah.
Is there any way to leverage like what the other AIs are doing possibly? So like when all of them are selling, could we somehow program like a system that buys stocks when they're at the price?
Yeah, there are actually some AI that do that exactly as you said. So when everyone else is like selling, when the price is ticking down, there are like fixer AI that go in and they buy when it's going down and they sell when the stock is going up. So there are actually algorithms that take advantage of that.
And that's another way you can diversify your AI portfolio. Yeah.
Do you see a realistic future where AI-powered algorithms will be able to have a real edge in the markets?
Sorry, can you repeat that?
Oh, sure. Do you see a real future where AI-powered algorithms for trading will have like a real edge in the markets?
I think already we can see that they have quite an edge in the market, because we are showing you where they fail, but they are extremely successful. We can kind of see that in the statistics of how they're increasing. They are very, very fast, and they are able to make a lot of money at once, right? So that's kind of how high frequency trading works. So right now, they do have a superior advantage over probably someone who is like an average level investor, but right now we see like really high level people are, you know, a different level above the AI. So I think that they do have a general edge. It's just that that edge is not absolute, and it's not something that you should trust once and for all. And it's also an edge that I think as AI becomes more accessible and, you know, it becomes so much more common, you know, if you have an advantage and everyone else has the same advantage, it kind of stops being an advantage. So I think that that's why you kind of have to be really smart about how you capitalize on this, you know, profitability.
And they're only going to have a bigger advantage because while everyone is competing to have the biggest advantage, they all want to use AI, and that's how technological innovation happens. And a lot of these high-frequency trading firms that are using AI, they're actually investing in market infrastructure to make like market connectivity better, to make speeds happen, trades happen quickly. So all of this goes into technological innovation where everyone is competing for the best AI. So it's already very profitable.
So for example, while I don't have the exact name of the model, my sources did say that for the Lyft example, it was basically this 1 to 2 models of AI that were doing all of the decisions. They were just so common. But we are seeing, like, as time goes on, more companies starting to produce their own and work with training their own data sets and coming up with superior strategies to be able to kind of capitalize on it. Yeah.
So a few years ago, when the country massively shorted like GameStop,
investors what?
Are they shorting the stock, the GameStop? How would that affect?
I don't actually know because I don't have statistics on that, but that would be a very interesting question. I can look into that and get back to you. Yeah, what's up? Oh, sorry. Yeah.
Okay, so you talked about AI with kind of profitability in mind. Do you see or have researched any particular models that not only have in mind profit, but maybe a user's particular like ethical preferences? Like if we talked about ESG stocks earlier, like would they take into account, okay, this user has is strongly aligned to sustainability goals and
We did actually end up, do you have that in the next slide?
Yeah.
Oh, sorry, go back to the previous, go back, this one's
There are a lot of AI models attached in the supplementary resources page. If you want to look at like how to start your own, how to connect it to an API, things like that. And there
If you
are
open this up, I think the source name labeled Frazier was also looking into ESG investing and that kind of like with AI. So if you kind of look into that, we have it in a card format, but you should be able to click the link and be able to open it on your own. And I think that yes, there are certainly models that do that and they are looking into it. But even if there weren't, I think that you can work with it to kind of, you know, it is essentially a program and you are able to communicate with your AI. It doesn't have this absolute control where you don't have any say. If you tell it certain things or certain companies that you're interested in, it will for sure start, you know, doing a lot of like high frequency trading in that area. So if that's what you're interested in, I think that's definitely a possibility. And I think Georgina, you have a question.
So I was wondering if, because I know that there's jobs where people will like look at the stock like where to invest. So is there like a possibility that AI can take over those jobs, like the same technology that they use to like actually invest your money, and like, or will it benefit the people who do those jobs, or is like this might be something that's going to start being completely taken over by AI?
Yeah, great question. I think that has actually is a pretty good question when you think about how AI is taking over jobs as a whole. If you think about it, it's pretty good and it's above average. At least that's where it is right now. So everyone who's kind of like in that middle zone and below in how well they are able to operate in their job is probably going to be like in trouble now and have to look for something else. But if you are like the best in your trade, there really isn't much that like actual like factor of your innovation and your specific special something that made you stand out amongst like as the best amongst, you know, in that group of people, you're probably not going to be replaced by AI. So similarly, I think that's going to be how it works. These really special experts who really know what they're doing probably aren't going to be replaced, but if you're like this average you know, investment advisor and stuff, you're probably going to be looking at how that's going to be more difficult. So I do think though, for those specific people, ways that they can, you know, stay on top of that is that they can really get to know AI, and then if they are really able to stay on top of technology and adapt with it and enter that higher group with this, you know, special knowledge, then I think that, you know, they don't necessarily need to be out of a job.
And that's why a lot of companies are like training their people so they can keep up with this innovation. Did you have a question?
You can.
Perfect. Yeah, thank you.